Welcome to our channel. In this video, we're going to talk about trading fundamentals. Before we start, we invite you to subscribe and hit the notification bell to receive all our notifications. Trading is a concept that covers both the specific and the broad. It is distinguished by its precision when referring to short-term investments, which can last from weeks to minutes. This practice is not limited only to stocks or equity markets, but also extends to operations in currencies, forex, commodities, futures, among others. Some define it as the ability to negotiate and speculate in the financial markets with the aim of making profits. It consists of buying and selling financial products over short periods. Today, trading is accessible to anyone who has a computer or device and an account with a broker that provides access to specialized platforms. However, before delving into this activity, it is essential to receive adequate training. Without a solid foundation in technical analysis and trading, there is a considerable risk of losing capital. It is recommended to take trading courses and practice on demo accounts to evaluate the accuracy of our chart analysis, as well as the interpretation of indicators and oscillators. Types of trading that exist. Technical operations focus on the interpretation of charts and visual patterns. Technical traders scrutinize the lines of stock or index charts, looking for buy or sell signals through the convergence or divergence of these lines. Momentum operations focus on identifying securities that exhibit significant movements in a specific direction, backed by a high volume of transactions. Momentum traders seek to capitalize on this momentum to make profits. Pros and cons. Below, we list the main advantages and disadvantages of momentum investing. Pros: it can be profitable for expert traders. It's faster than other long-term investment methods. It does not require as deep an understanding of value or fundamental investment. Cons: price volatility can be unpredictable and high risk. The shorter the investment period, days, hours, minutes, the greater the risk involved. Emotions can make a momentum strategy unsuccessful. Swing operations take advantage of the volatility that arises at the end of a trend when a new trend is in the process of being established. Swing traders enter the market during these moments of volatility, maintaining their positions for more than a day but less than trend operations. They usually base their decisions on trading rules, either technical or fundamental. Pros: clarity of the limits. It affects market entry, the realization of the profit point, and the setting of the stop loss. In this way, you avoid major losses and gain greater security when increasing your profits. If you see that the prices do not acquire the trend or counter-trend you had anticipated during the first hours, you can close your position to not register higher losses. You do not have to go against the market. You have to study the historical price series to predict where they will move. You don't have to predict movements that turn out to be unnatural. Supportable risks. As the stop losses are small, you will not assume excessively high risks in your operations, so they adapt well to moderate investor profiles. Less constant attention. You won't have to be as attentive to the screen as in intraday trading operations, so this investment style will not excessively stress you and can be more easily complemented with other occupations. Before continuing, we invite you to subscribe, like, and hit the notification bell to receive all our notifications. The cons of this type of trading. On the other hand, you also have to be very aware of the complications that this trading model entails. Take note of them. More frequent stop losses. While these automatic loss controls can come in handy to avoid greater damage, you also have to keep in mind that you will incur more frequently in the smaller ones. Exposure to market variability. On the one hand, it is always interesting to be able to guide yourself by the historical price series that you can verify in the market evolutions. But, on the other hand, as this turns out to be unpredictable, when unexpected changes occur, significant losses can occur. Beware of opening gaps. As this type of trading entails that positions remain open over days, you have to consider that the prices at which the markets open can generate significant gaps. These can make you lose almost immediately all the gain you had previously obtained. In short, swing trading is an investment modality in which you can achieve great benefits if you are a good specialist in technical analysis. Study the historical variations of prices and establish limits that avoid volatility, although they also suppose to reduce your profit margins. Volatility describes the variability and speed with which the price of an asset changes, with cryptocurrencies known for their high volatility. Profitability is variable due to the volatile nature of cryptocurrencies. It's crucial to avoid being influenced by trends or fads in the world of cryptocurrencies, as it's susceptible to subjective opinions. Instead, it's recommended to make independent investment decisions based on reliable information and careful analysis. For this, technical and fundamental analysis techniques can be employed. Technical analysis. Technical analysis is a methodological approach used to determine the trends of an asset by analyzing historical market behavior. This method involves examining past price movements with the goal of predicting future behavior by identifying patterns. This technique primarily focuses on studying the price using cryptocurrency charts and tools like indicators to monitor all transactions in search of investment opportunities. Despite the inherent volatility of cryptocurrencies, they also present identifiable market cycles and repetitive trends that allow visualizing opportunities to operate. Technical analysis is especially useful for making short, medium, and long-term decisions, as it generates strategies adapted to individual expectations and facilitates risk management. To conduct effective technical analysis, it's important to consider several elements. Trend shows the general direction of the price beyond normal fluctuations. Charts. Tools that represent the evolution of the price over a specific period, such as financial charts and Japanese candlesticks, which allow analyzing the movements of minimum and maximum prices at a specific moment. Technical indicators, statistical tools that help predict future market movements. Some common indicators include the Simple Moving Average, SMA, which calculates the trend of an asset based on its closing price over a specific period, and the Relative Strength Index, RSI, and Bollinger Bands, which can identify investment opportunities and evaluate whether an asset is overbought or oversold. Fundamental analysis. Fundamental analysis is a method used to evaluate the real valuation of an asset. Unlike technical analysis, this approach dispenses with charts and indicators, directing all attention on internal and external information that can affect the value of a cryptocurrency. It's based on studying the fundamentals of the asset, such as its monetary policy, its community, or its relationship with the traditional economic system. The goal of fundamental analysis is to determine if an investment is genuinely valuable or if there are better opportunities in the market. Instead of using statistical data to make buying or selling decisions, it uses historical and current information about the asset to predict price movements based on financial values, public network data, and macroeconomic conditions. All this contributes to evaluating the financial risk of an operation, understanding the real value of an asset and its long-term behavior. Some essential data for fundamental analysis include number of active addresses, indicates the number of addresses participating in transactions over a specific period, providing information on the actual use of the network. Number of transactions and their average value, reveals the amount of money moving within the blockchain. Network millionaires, known as whales. They are holders of large amounts of cryptocurrencies that can influence their value and affect decentralization. Network fees. Transaction fees can indicate existing demand, hash rate or staking amount, helps assess interest in mining a cryptocurrency, the efficacy of transaction processing, and network security. Financial metrics. Data reflecting the financial situation of a cryptocurrency. Market capitalization represents the total value of a network. Transaction volume indicates the community's interest in a particular cryptocurrency. Asset distribution. The different modes of distribution and circulation of assets in the market can influence the price of cryptocurrencies based on their availability. Despite the high volatility of assets, the price of cryptocurrencies can be analyzed to predict their future behavior. To achieve this, it's necessary to understand and practice both technical and fundamental analysis. We warmly welcome you, hoping to have you in our next videos. Don't forget to like, subscribe, and activate the notification bell.